What's a stock market index? A stock market index is a measure of the performance of a group of stocks that represent a particular segment of the overall stock market. Stock market indices are often used as benchmarks to track the performance of a specific market, sector, or industry. A stock market index is typically constructed by selecting a group of stocks that meet certain criteria, such as their market capitalization, sector, or industry. The index is then calculated by combining the prices of the individual stocks in the group and calculating an average or weighted average. Changes in the prices of the individual stocks in the group will impact the value of the index, providing investors with a way to track the overall performance of the stocks that make up the index. There are many different stock market indices, each of which tracks a different segment of the stock market. For example, the S&P 500 tracks the performance of the largest 500 publicly traded companies in the United States, while the Nasdaq Composite Index tracks the performance of technology companies listed on the Nasdaq Stock Exchange. Other indices track specific sectors, such as the Dow Jones U.S. Real Estate Index or the MSCI World Energy Index. Investors use stock market indices as a way to gauge the overall health of the stock market or a particular segment of the market. By comparing the performance of their own investments to a relevant index, investors can better understand how their portfolio is performing relative to the broader market. Researching the biggest companies in the stock market can be a helpful way to understand the overall trends and performance of the market. One common way to do this is by looking at the companies included in major stock market indices, such as the S&P 500 or the Nasdaq Composite. For example, as of early 2023, some of the largest companies in the S&P 500 included Apple, Microsoft, Amazon, Alphabet, the parent company of Google, and Facebook. These companies are all well-known technology giants that have enjoyed strong growth and profitability in recent years, and their inclusion in the S&P 500 has helped to drive the overall performance of the index. Of course, it's important to remember that past performance is no guarantee of future results, and that investing in individual stocks carries a higher level of risk than investing in a diversified portfolio. It's also worth noting that the largest companies in the stock market can change over time as market conditions and investor sentiment shift. Nonetheless, researching the biggest companies in the stock market can be a helpful way to gain a better understanding of the overall trends and performance of the market, and can be a useful starting point for further research and analysis. What have been the biggest drops in the history of the stock market? There have been several significant drops in the history of the stock market. Here are a few examples of some of the biggest drops. 1. Black Monday, October 19, 1987. On this day, the Dow Jones Industrial Average dropped by 22.6%, which was the largest single-day percentage decline in the history of the index. The exact cause of Black Monday, which occurred on October 19, 1987, is not entirely clear. However, many analysts believe that the crash was caused by a combination of factors, including a buildup of market speculation, rising interest rates, and the use of computerized trading programs. In the years leading up to Black Monday, there had been a significant increase in the use of leveraged investments and derivatives. The reasons behind that, which many experts believe led to an overheated market. Additionally, interest rates had been rising in response to inflation concerns, which may have contributed to investor anxiety. On the day of the crash, a series of events triggered a massive sell-off, including computerized trading programs that automatically sold stocks when prices dropped, exacerbating the decline. The crash was global, with markets in the United States, Europe, and Asia all experiencing significant losses. The extent of the market decline on Black Monday was unprecedented. The crash had a significant impact on global financial markets and led to a period of market volatility and uncertainty in the years that followed. 2. The dot-com bubble burst, March 11, 2000, October 9, 2002. The dot-com bubble burst resulted in a 78% decline in the Nasdaq Composite Index, which was heavily weighted towards technology stocks. The dot-com bubble was a period of rapid growth in the technology sector that occurred in the late 1990s and early 2000s. During this time, many internet companies saw their stock prices skyrocket despite having little to no profits, leading to a wave of speculation and investment. However, the bubble burst in March 2000 when the Nasdaq, which was heavily weighted toward technology stocks, began a steep decline. Many internet companies were unable to meet investors' expectations and were ultimately unable to survive the downturn. The decline continued for 2 years, with the Nasdaq losing more than 75% of its value from its peak in March 2000. The bursting of the dot-com bubble had a significant impact on the economy, leading to the failure of many internet-based businesses and causing significant job losses in the technology sector. Many investors suffered significant losses as well, and the decline was seen as a cautionary tale about the risks of investing in speculative markets. However, the bubble also led to the emergence of more mature internet-based businesses that were able to weather the downturn and establish themselves as long-term players in the technology industry. 3. The global financial crisis, September 15, 2008, March 9, 2009. The global financial crisis resulted in a 57% decline in the S&P 500 index, which was caused by the subprime mortgage crisis and the collapse of several major financial institutions. The global financial crisis of 2008 was a big problem that happened around the world because banks and other financial institutions made a lot of bad loans to people who couldn't pay them back. This caused a big drop in the value of homes, and lots of people lost their homes. The banks had also invested a lot of money in these bad loans, and when they started losing money, they couldn't pay back the people who had invested in them. This caused a lot of worry and panic among investors, and many people wanted to take their money out of the banks. Governments around the world tried to fix the problem by giving money to the banks and trying to make them stronger. They also tried to get people to spend more money to help the economy. But even with these efforts, the crisis caused a lot of damage to the economy and many people lost their jobs. 4. COVID-19 pandemic, February 12, 2020, March 23, 2020. The COVID-19 pandemic resulted in a 34% decline in the S&P 500 index, which was caused by concerns over the economic impact of the pandemic and widespread market volatility. The COVID-19 pandemic started in early 2020 and it's a big problem that is affecting people all over the world. Because so many people are staying home and not going out as much, it has caused a big problem for businesses and the economy. Many people have lost their jobs or can't work as much as they used to. Why is this important? Learning about the history of significant drops in the stock market is important for several reasons. Like, understanding market cycles. By studying past market drops, investors can gain a better understanding of how the stock market works and the different cycles that it goes through. This knowledge can help investors make better decisions about when to buy and sell investments. Managing risk. By learning about market drops, investors can gain a better understanding of the risks involved in investing in the stock market. This knowledge can help investors make more informed decisions about how to manage risk in their portfolios. Avoiding emotional reactions. By understanding the history of market drops, investors can avoid making knee-jerk reactions during times of market volatility. This can help prevent investors from making decisions based on fear or greed, which can lead to costly mistakes. Preparing for the future. By learning about past market drops, investors can prepare for future market downturns. This can involve taking steps to diversify their portfolios, managing risk, and having a long-term investment strategy. In summary, learning about the history of significant drops in the stock market is important for investors who want to make informed decisions about their investments and manage risk in their portfolios. If you want to continue learning about my experiences in the stock market as a newbie, please remember to like and subscribe. More interesting data on the next videos.